Okay, well, let's get started. I'd like to welcome everyone to the 8th annual meeting of the Investor Advisory Group. This is an especially important forum for the PCAOB because it provides the board with an opportunity to hear directly from our primary constituency, namely investors and investor representatives. At the outset, I'm required to issue a disclaimer, which I do for all the board members and staff who are participating today. Under our board policy, the views we express are our own and do not necessarily reflect the views of other board members or the staff of the PCAOB. Having said that, I believe I speak for the board and this Investor Advisory Group in welcoming you, Chairman Clayton, and in expressing our deep appreciation for the Commission's action yesterday in approving the new standard on the audit reporting model and for your personal strong support for the objective of the rule. Adoption of this rule has been a long-standing, very high priority of this group, so I want to thank not only you and your staff, but all the Investor Advisory Group members here today and those who have participated over the years in advocating so strongly for its adoption. These changes to the auditor's reporting model, I believe, will launch a new era in investor transparency into the audits of public companies in the United States. I also want to welcome Wes Bricker, and Mark Panucci, the Chief Accountant and the Deputy Chief Accountant. In order to achieve the best results for investors, the PCAOB works closely with the Commission and particularly with the Commission's Office of Chief Accountant. The close cooperative relationship that exists between our two organizations is in large part a result of the efforts of Wes and Mark. So thank you, Wes, and thank you, Mark, for your interest and assistance. In a moment, I will ask everyone at the table to introduce themselves and the organizations you're with. But for now, I would like to express my appreciation to all of you for participating in today's meeting and for your hard work on your respective working groups. I want to especially thank the working group co-leaders for their time and effort, and we'll be hearing from them as well as all of you during the course of the session. We'll also have a brief presentation about digital financial statements, their growing importance, and what, if any, role auditors should play in this arena. Next, we will turn to the auditor's consideration of a client's noncompliance with laws and regulations, and conclude with a discussion of audit quality initiatives, a topic which is also of ongoing interest to this group. The Investor Advisory Group was formed to provide a public forum specifically for the board to obtain the views of and advice from the broad investor community on audit oversight matters affecting investors. This group and these meetings allow the board to hear directly from investors, as more often than not, regulators hear from the regulated more than they hear from the investing community. The way this group operates, they select the topics they would like to bring to the board's attention, organize themselves into subgroups, and then present their findings and recommendations for the board's consideration. Over the past 7 years, this group has focused on such topics as the need to update the audit reporting model, which I just mentioned, greater transparency of individuals and other auditors involved in audit engagements, which the Commission has also approved, a greater transparency of the need for clarification of FASB, FASB, and PCAOB going concern standards in light of past financial crises, and the very few opinions that were issued during these crises, and a variety of other concerns relating to independence, objectivity, and professional skepticism, the role of audit committees, the audit firm business model and incentives, greater transparency and governance of audit firms, and lessons learned from the financial crisis. Each of these topics has prompted subsequent meaningful consideration by the board, and in a number of instances, board action. In a moment, Chairman Doty will provide a brief summary of some of the board's recent activities, and I hope all of you, this group, will recognize how much you have helped to influence the board's priorities. Just as in the past, the board intends to carefully consider the views you express throughout the day. And now, I would like to turn to Chairman Clayton for any remarks he may wish to make, and I know, Mr. Chairman, that you've got limited time here. We very much appreciate your making the time to be with us, and then I'll turn to Chairman Doty and then to other board members who may wish to make statements. So thank you, Chairman.
Thank you. Thank you, Steve, and I'm going to associate myself with your disclaimer. I also add another disclaimer, which is I often depart from my prepared remarks, but I try not to do so with a material misstatement or omission, because that would be inconsistent with our brand. Anyway, and the first departure is thank you for that list of past items, because they're all very important, and I'll come back to that. But I also want to thank Chairman Doty and Board Member Jeanette Franzel, who, along with Steve, I know work very hard to advance the mission of the PCAOB. And I want to especially thank you for your continued leadership of this group, including your commitment to seeking the views of the investor community. That's important to us here. It's important to us across the landscape of what we regulate. And I'd be remiss if I didn't thank the entire PCAOB staff for the dedication to the PCAOB mission and commitment to improving audit quality. And I want to thank all of you, the members of the IAG. I know that you have day jobs and are very busy. And your commitment involves not just these meetings, but preparing for them as well. We are grateful that you take the time to contribute your knowledge and expertise on topics important to high-quality audits and reliable financial reporting. The PCAOB's mission is critical because auditors serve a vitally important role in our markets. Financial statements audited by ethical, independent, and skeptical auditors who apply consistent standards as well as necessary diligence are essential to informed decision-making. And as we all know, informed decision-making is essential to the proper functioning of our capital markets. Investors are the ones who make capital allocation decisions, and you have a keen sense about whether you have an appropriate mix of information, including financial information. Your input is critical for the PCAOB to achieve its mandate. In this respect, I'm pleased by the level of coordination that occurs between the SEC and the PCAOB in advancing our respective missions, including most significantly our shared investor protection goals. This coordination is also as important for the other tenets of the SEC's tripartite mission, to facilitate capital formation and maintain fair, orderly, and efficient markets. In that regard, maintaining and enhancing the U.S.'s position in the world's deepest, most dynamic, and most liquid capital markets with the most robust investor protection requires, among other things, rooting out misconduct that harms investors and impairs market integrity, including accounting fraud and circumvention of established professional and regulatory standards. Therefore, I look forward to the SEC continuing to work together with the PCAOB as we pursue our mission. Moving to today's agenda, you have a full agenda. You've already gone over it, so I won't repeat that. But I know that the board, the PCAOB staff, and our staff are looking forward to your input on these matters. One item that the IAG has discussed at previous meetings, as you mentioned, is the auditor reporting model. As you're all aware, yesterday we took action in this regard, including the CAMs. The requirement to disclose CAMs in the audit report is intended to provide investors with other financial statement users with the auditor's perspective on a set of matters discussed with the audit committee. I'm going to depart again from my prepared remarks, and I've said this to Steve, I've said it to Jim, Jeanette as well this morning. In my experience in the markets, the audit committee and the emergence of the audit committee as a focal point for discussion of critical disclosure matters is one of the single best developments for investors in the markets in the last 20 years. When I go to see a company for the first time, that's where I focus initially. What are the matters that have risen to the level of audit committee attention? Because you get a feel for the issues that management cares about, that the audit, both from a attention point of view and from a, how do we run the business point of view. I think that this measure and its intent to capture that dialogue and provide it in a reasonable way to investors is very important. You will note that in my prepared statement yesterday, there was some skepticism because I could see this not working out the way we intended to. I will be vigilant. I know Wes will be vigilant. Mark will be vigilant in trying to ensure that it does work out in a way that investors have a feel for that dialogue without creating boilerplate or a pullback in audit committee communications. So back to my remarks. I believe well-functioning audit committees provide substantial value to shareholders. I commend the board and the PCAOB for their staff for the dedication to this rulemaking, and I'd also like to acknowledge the input that this group provided to the project, which undoubtedly improved the final product. While I cannot be here for the whole day, Wes will be here, Mark will be here to join in your discussion, and we look forward to the PCAOB's progress on the initiatives you will be discussing today and in the future. Again, thank you for your commitment to assisting the PCAOB in its vital mission, and thank you for inviting me to be here today. It is truly beneficial for both the SEC and the PCAOB.
Well, thank you very much, Chairman Clayton. And I also want to recognize the leadership of Chairman Doty in sponsoring the initiatives, both the transparency, the audit reporting model, and so many others. So we very much appreciate, Mr. Chairman, your dedicating yourself to the advancement of so many of the issues which are topical to this particular group. And with that, I turn it over to you.
Well, thank you, Steve. First, I'm going to invoke Chairman Clayton's rule and depart from text. To say that this would be an unusual day, an important day for the Public Company Accounting Oversight Board and its Investor Advisory Group would be something of an understatement. We have Chairman Clayton's statement regarding the release of the public of the audit reporting model, and we have his presence. He has come for the first meeting with the Investor Advisory Group, so it's a very important day. And I want to reconstruct a bit of the record here. First, what you have heard is cannot be emphasized enough. This could not have happened without the diligence and the attention and the hard work of Mark Panucci and Wes Brooker and Chairman Clayton and the staff. Anything like this requires an attention to the details. When Chairman Clayton arrived, on arrival, he was faced with this issue. This was one of the issues that was going to have to be decided on a close, tight timeline. It wasn't the only one he had. But the first thing he said to me about the audit reporting model was that he had a very simple goal. He wanted to understand it. He wanted to understand the details. He wanted to get it right, and he wanted to feel good that it was the right thing to do. What a wonderful charter from a lawyer heading the Securities and Exchange Commission about the goal of standard setting and rule setting in an administrative society. He wanted to know the details and to feel good about them because heads of agencies are accountable for the details. If the drafting isn't good, if the rule doesn't work, we're expected to have some responsibility for that. With that, I also commend you to the release yesterday. The release is, in my humble view as a lawyer, a model of concision, a model of analysis. It represents the best kind of drafting that the SEC has produced over 80-odd years, and that it carefully and meticulously takes on every comment that was received, every issue raised in the comment process, and it disposes of them or deals with them or acknowledges them with elegance and with accuracy. This was all done at a time when there was other work before the Commission and the staff, and I'll allude to that in a minute. But here I will stop in my extempore remarks. They always make our General Counsel and our Chief Auditor a bit nervous, and I will go back to what we had planned to discuss, except to say also, with our deep appreciation to Chairman Clayton and to all of you here present. Our colleague Louis Ferguson is under the weather. He joins us, and so this was not the last time you'll hear of it. The other standard setting that we have going is very important. It is not perhaps as controversial or as challenging as the audit reporting model, but it may be even certainly as important for the quality of the audit. First, we have a proposal out regarding other auditors and their responsibility, especially in international audits, for the role of the lead auditor and the conduct and the supervision of other firms participating in the audit. And that links in a way with our auditor search website and the material we are causing to be accumulated under the transparency release on other participants in the audit and the engagement partners. That database is building. It's building rapidly, and we think that a proposal on other auditors that makes clear the responsibilities of the lead auditor is very important for spreading the evenness and the quality of the audit throughout a global system. We have a proposal on estimates, fair value, and specialists, and that's gone through a lot of work. And we hope that we will get these projects after consultation papers and proposals and discussions with advisory groups. We hope to have in fair market value estimates and the use of specialists come to fruition early in 2018. And those will be, we think, useful for investors and users of financial statements, but also for the auditors. We have a research agenda. It includes a research project on quality control standards. Quality control standards has been a long-standing concern of the community that involves users and preparers and auditors. And here we had to dedicate substantial focus to the need for it, why it was something that should be addressed, and the alternatives, and whether and why standard setting was the appropriate approach to elevating quality control standards. That is well along. We hope that you will hear more of it. We will be researching changes in the use of data and technology, the auditor's role regarding other information, non-GAAP metrics, and others. And this, of course, will be research that we will be sharing with and coordinating with the SEC because of their keen and public interest in this area. Auditors' consideration of the non-compliance of auditors, of management, the non-compliance of issuers with laws and regulations. The auditor's duty and the limits of the auditor's duty and the auditor's opportunities to improve this area are a consistent, long-standing problem for the corporate bar, for the investor community, for all of us who are concerned in not just in good financial reporting, but in the extent to which good financial reporting and good auditing has a knock-on or an ameliorative effect on corporate conduct in the boardroom, and this is part of that. So those research projects are all going to be underpinned by in-depth economic analysis. We will use both external research and our own analysis of the data that is in our file and is accumulating. And as you know, we have worked hard to build an Office of Economic and Risk Analysis that combines both independent academic analysis and research and our own risk analysis for our purposes of selecting and inspecting audits, and we will continue to work on that. One of the first projects that is coming out of that will be, I think, of interest to this group is our first post-implementation review of our engagement quality review standard. Once was called AS7, it was adopted in 2007. As one who's not yet mastered the new categorization of the standards, but it is the engagement quality review standard. The analysis and the depth of the analysis and the extent of consideration of variant conduct is, I think, is sweeping and is important. It relates to what Chairman Clayton has just said about the willingness or the ability to go in and consider the conduct which is unintended and which should be perhaps the subject of fine-tuning and of adjustment. We will have, I think, soon a public report out on the results of our post-implementation review, and the insights and the changes in the EQR process we think will be useful. It takes a lot of time to measure the impact of an inspection program, but we are now beginning to see the fruits of review of that program. We now have research that is academically based and that is out there, is open to peer review, and that confirms that issuers and auditors that work in regimes that are subject to audit oversight enjoy additional access to capital, they enjoy premiums, and they engage in enhanced investment opportunities. So we're getting the research is beginning to come in that confirms the value to the capital formation process around the world in jurisdictions where there are U.S. issuers and non-U.S. issuers that are inspected by PCAOB registered firms and confirming the fact that that has, again, a spillover, a positive spillover and knock-on effect on the capital formation process there. We will this year look at portions of more than 270 audits of the 6 largest U.S. firms. We will look at portions of 140 other engagements by foreign affiliates of those firms. We'll examine portions of 400 audits conducted by 150 smaller firms here and abroad that are not part of the big network. And internationally, we can do this now because we now have the ability to inspect in 50 other countries. Local regulators in 20 countries conduct joint inspections with us. We will look at 60 foreign firms this year, just foreign audit firms that are registered with us. We've concluded 22 bilateral cooperative agreements. 14 of these are in Europe. We have narrowed the list of European jurisdictions with which we don't have these arrangements to a very few, less than a handful. We've added Italy this year. We're soon going to have Ireland. We have Ireland inked, or prepared to be inked. These relationships are established. They're maintained through the hard work of our Office of International Affairs. That office works closely with our Enforcement Division. Those 2 offices work very closely with the Office of International Affairs and Division of Enforcement of the SEC and with our counterparts in these other jurisdictions. So this has become an established, well-rooted network of sharing of information and techniques. Last year was the most productive in the history of the PCAOB for enforcement. We had a record number of settled actions. An increasing percentage of these, 40% last year, involve foreign firms, which I think is part of our commitment to assuring that there is uniformity, that there is a level playing field among auditing firms and the issuers who use them, and the issuers who have good audits and the issuers who may leave something to be desired. We think that we're on track for another high percentage of foreign firms who appear in our enforcement file this year, but as I say, that's going to be coordinated closely with the SEC's Division of Enforcement, and these are, of course, confidential until they are concluded. With that, I think I'll turn it back over to Steve. Thanks again to both of you.
Well, it's quite a pleasure to be sitting next to 2 Washington lawyers, I guess, in New York and Washington. I mean, it's nice to hear them both speak extemporaneously and
hold your wallet.
And with prepared remarks. It's held, and believe me, it's tightly fastened. But now I'd like to recognize Jeanette Franzel, and Mr. Chairman, Jeanette has played a lead role in terms of our outreach to audit committees. Jeanette?
Yeah. Thanks, Steve. Steve, I want to thank you for your leadership of this group over so many years, and I want to thank all of you for being part of this. I know that this group does some very heavy lifting in terms of brainstorming and research and input, and the topics that we're covering today are going to be so important to our current research agenda. So I was very happy when I saw the current agenda for today because it aligns very well with some very difficult questions that we are taking up, specifically dealing with the auditor's role. And over the years and decades, there's been a problem with an expectations gap, in auditing. And unfortunately, often the way that expectations gap was dealt with was to just more clearly delineate what is the responsibility of the auditor versus what is not. But I think on the non-GAAP measures and the auditor's consideration of an auditee's non-compliance with laws and regulations, we need to really take a fundamental look at the auditor's responsibilities. Are they appropriate in today's day and age? And based on what investors need and expect. And so in that regard, these will be very difficult standard-setting efforts for us, and so your input today will be very important. Also, the audit quality initiatives. I've been a big fan of audit quality indicators and conversations between audit firms and audit committees, and even from the demand side with audit committees, wanting to know what firms are doing to track their own quality. And so I think we need to figure out what is the next step here and what's the current state of affairs. So again, very important topics, and we will be very anxious to hear your input and the discussion today. I was also happy to see the digital financial statements added in as a topic, so I'll be interested in hearing that. And I think that the pace of change in financial reporting and auditing is happening so quickly that this group and the PCAOB will be faced with a lot of difficult issues going forward on what is the auditor's role when we're looking at the use of technology and other changes that are happening in financial reporting. So I think how we approach these topics that we're dealing with now, where we're looking at the auditor's role, it'll be a very important model for the future, as I think we're going to have to be doing analysis and standard setting at a much quicker pace than we ever have in the past. And in that regard, I'm very happy that we've moved so many of our standard setting projects because we do have some very important and fundamental issues to work on going forward. So again, I welcome you and thank you, and I look forward to the discussion today.
And now if we could just quickly go around the table, and I'd ask everybody to introduce themselves, and as you participate throughout the day, please you give your name before commenting so the listening audience knows who is speaking. And why don't we start, Kevin Chavers, with you? And I know you're testifying tomorrow, so I appreciate your before Congress. So I appreciate your making the time to be with us today.
No, it's my pleasure. Thank you, Steve. I'm Kevin Chavers in the Public Policy Group at BlackRock, and pleased to be with you this morning.
I'm Mary Brousseau from Brousseau Capital Management, and I'm from San Francisco area, and I'm delighted to be here.
I'm Tony Sondi. I run a financial consulting and investment advisory firm.
Good morning.
Glad to participate. Please.
Good morning, everybody. I'm Linda de Beer. I'm from South Africa, and I'm a non-executive director on a couple of listed company boards where I often chair the audit committee. I have a fairly long background in history and international auditing standards. I chaired the advisory group of the IAASB for quite a few years.
And thank you for making this long trip. I know there's quite a bit going on in South Africa at the moment, and we might want to pick your brain a little bit about what we can learn from that. Norman?
Thank you, Steve. I'm Norman Harrison, based here in Washington as a managing director with Duff & Phelps, where my practice includes consultation with investment advisors on a variety of compliance and regulatory and litigation support, regulatory support issues.
Mark Panucci, the Deputy Chief Accountant at the SEC.
Larry Shover, CIO of Institutional Commodity Pool in Chicago, a contributor to News Corp. And I just want to say thank you to new chair Clayton, a fellow Penn grad. So we're in good hands.
Good morning. I'm Robert Tarola. I have a turnaround financial consulting firm here in Washington, D.C., but I was a former partner of a Big Four firm. I've been the CFO of several public reporting companies, and I'm the chair of 3 audit committees of public companies.
Good morning. My name's Anne Simpson, and I work for CalPERS, where I'm an investment director. I'd like to say that we've written not once but several times in support of these reforms to the audit model, and can't stress how important it is for the quality of markets, not just for capital allocation but for our stewardship role. And although we think of CalPERS as being this enormous, great 330 billion plus fund, we're investing on behalf of ordinary working people, the police, the firefighters, the janitors, the judges of California. So ensuring that the flow of information in markets is high quality, relevant, and reliable is essential, and the auditor's role in that cannot be overstated. So we'd just like to record today, thank you very much for yesterday's announcement.
My name is Michael Head, and I'm currently a lecturer at Texas A&M University and retired chief audit executive at TD Ameritrade with primarily background in risk management, internal controls, and internal and external auditing.
I'm Lynn Turner, and thank you, Mr. Chairman, for the vote
it's
yesterday.
Great to see you.
Yeah, it is, Jay. So that, I think the kudos to you and Wes and Mark can't be enough. And I've been in the profession for 4+ decades, and it's actually nice to finally get a new audit report. So give them something to test on the CPA exam next time. So at any rate, I sit on the board of a $50 billion state pension plan at the behest of the governor, and we have the good fortune of having an outstanding chief investment officer that does a great job for us and keeps us our risk managed anyway. So with that,
Good morning. I'm Michael Smart. I'm managing partner of CSW Private Equity. I'm also vice chairman of the National Association of Investment Companies Association, representing more than 90 billion AUM of private equity and hedge funds. Thank you, Mr. Chairman, for inviting me to participate in this forum, and thank you for your leadership over the years, particularly as it relates to the most recently released SEC documentation.
Good morning. Wes Bricker from the SEC, Chief Accountant. Wanted to do just a few things before we started. One, associate both myself and Mark with the disclaimer. That may be important. Also to reiterate and associate, Jay, your comments about the appreciation and thanks for the input from this group, which is valuable. Also the collaboration, the cooperation that we've enjoyed working on tough issues with the PCAOB. So really appreciate the collaboration there. And certainly look forward to the dialogue throughout the day.
I'm Amy McGarity. I'm the Chief Investment Officer for Colorado PARA, the board that Lynn just spoke about. So for those of you who don't know us as well as Lynn does, we're a $47 billion plan in Colorado. And I think one of the things that makes us a bit unique is that we run more than half of our assets internally. So we have a relatively large investment staff managing assets on behalf of the membership of Colorado PARA, picking stocks and bonds on a daily basis. And so these issues that we discuss here, we're very familiar with and keen on helping to be part of the conversation. So I appreciate the opportunity to be here. Thank you.
I'm Grant Callery. I spent the bulk of my career working for NASD and FINRA, retired 5 years ago as general counsel there, and since that time have been working with them on their financial education foundation, and also in some areas with higher ed governance with the Association of Governing Boards of Universities and Colleges.
Good morning. I'm Marty Baumann, the Chief Auditor and Director of Professional Standards at the PCAOB. And as someone who has worked many hours over several years trying to craft a new auditor's report with a very talented team of people, I want to express my appreciation to the IAG for your support for the need for a new auditor's report over many years, and express my appreciation to the SEC for the hard work you put in coming up with the approval order yesterday. It was a very good day for our team, and I think for investors in the capital markets. So thank you very much.
And now, if we could get on with the schedule, we've arranged it, Mr. Chairman, that we have our working groups, and they'll speak to up to 10 minutes on the various topics, and I know you've got to leave at around 10 o'clock, so I think that fits in perfectly with the timing. So first of all, I'd like to recognize Tony Sandy and Amy McGarity, who summarized their slides on non-GAAP financial measures.
Thank you, Steve, and Chairman Clayton. We began work with the non-GAAP measures and key performance indicators last year. We presented perspectives of our team on that, and we're continuing this year. The use of non-GAAP measures and other key performance indicators has grown over the years. There are really a plethora of research studies that talk about that, show you how much they've grown and so on. Management has long insisted that non-GAAP measures better reflect the way they manage the company, the way they reward performance than most GAAP metrics do. Investors for many years have also used, and they continue to demand, non-GAAP measures just as well as any of the GAAP information that they use. Many investors find it quite useful to get management's perspective with respect to those non-GAAP measures. The standard setters, both the FASB and the IASB, in its issuance of IFRSs, have not effectively kept up with this demand or need for performance metrics, at least not in the way that management has been talking about them. We also find over the last several years that there's a much better, much higher association with management compensation, for example, of these non-GAAP measures. But the research, both academic and street research, continues to find it very difficult to show any value relevance to those non-GAAP measures. Their predictive ability, their correlation, or their ability to inform us about market prices in the long run is still suspect with respect to, as I said, the academic research and much of the street research. Very recently, for example, there was a study that showed that non-GAAP measures are more highly associated with companies that have normally reported lower earnings and excess management compensation. But don't get me wrong, as an investor, I do want management to tell me what they're doing, how they're managing their business, and how they look at performance. Now, going back to the standard setters, and I don't want to understate the amount of work that the SEC has done with respect to non-GAAP measures over the last few years, and I think there's been tremendous progress there as well. And yet, we find that non-GAAP measures, as provided by companies, the amount of time that's devoted to non-GAAP measures in the earnings calls, for example, the information that's provided in the earnings releases, there's a lot of non-GAAP information there. In fact, at times, I think it sort of just about drowns out any GAAP information that's provided in these earnings conference calls. So fundamentally, the question is, what is it that we need to do about this? Management, as I said, continues to use it. Investors continue to demand that information. There is some evidence that there is at least a short-term reaction to the announcement of non-GAAP measures. I haven't seen research that shows that that has a lasting effect. So what we're doing today is we're going to talk about what we think ought to be done. One possibility that we will discuss is that the standard setters ought to define performance metrics and then require that they be part of the financial statements, would therefore result in their being audited, and so on. One of the most difficult problems with respect to that is simply the fact that if you look at the most commonly used non-GAAP measures, for example, EBITDA, adjusted EBITDA, and so on, earnings before interest, taxes, depreciation, and amortization, what's very important to understand is that these measures often leave out those costs of running a company that are probably the most critical. Companies leave out stock compensation expense, for example. They leave out the amortization of intangibles. It's very difficult to see how that is relevant when a company relies on stock compensation, when it relies on acquisitions to stay ahead of the technology. So our problem, therefore, is very difficult. It's complex in the sense that we need management to tell us which non-GAAP measures they're using, what matters to them, and yet we find that they're leaving out information that seems critical to managing the company. And that brings a dilemma with it, in other words, that if you if you audit a number that's not reflective of the cash generating ability or it's not reflective of the value, then what is it that you're doing with respect to that? So as I said, we're proposing that the FASB and the IASB, the standard setters, define these. However, we're concerned that that may be outside the remit of these organizations. And there is very little evidence that they're actually doing any of that. The IASB has recently proposed an EBIT measure, right? But at the same time, they're not talking about going any further than that. The FASB, in its most recent plan for the next couple of years, doesn't talk about discussing or doing anything about performance measures. An alternative that we're also going to suggest today is that the standard setters ought to define the location, the disclosure requirements, the reconciliation, and presentation requirements for non-GAAP measures and key performance indicators that would be defined and selected by management. And therefore, it continues, in other words, to allow management to tell us what they think is really critical. But it then puts a framework around it that allows us to get the kind of information that we need from an investment perspective. In addition, we think that management, once they select a non-GAAP measure or key performance indicator, ought to provide that information for at least 3 years. In effect, therefore, we can track that. Even if they decide after a year, let's say, not to do it anymore, or not to use that particular indicator anymore, they still would have to continue providing that information. Management would clearly define the indicators and why they're using them. They would also provide comprehensive reconciliations. It's important that the reconciliation that they provide be traceable back to the GAAP information that we have. The last point with respect to that we're going to discuss today is also the issue of the proliferation of these non-GAAP numbers in earnings conference calls and earnings releases. And so we're going to propose that those be reconciled to the information that's provided in the financial statements as well. And if that could be placed in a footnote, then that could be audited as well. Okay. Thank you, Steve.
Amy, do you have? All right. Well, then, thank you very much, Tony. Look forward to the discussion throughout the day and your leadership on this. Grant and Mary, let me turn it over to you on the auditor's consideration of the client's noncompliance with laws and regulations.
Thank you. Mary Rousseau speaking. Chairman Clayton, thank you for joining us today. I think it's a very important topic, and thank you to the board and the staff. We know the staff is working on this issue as we speak, and we decided to focus our efforts on really two things. One, defining what it is investors expect. And thank you for your comments. You kind of took away my comments. But investors have very high expectations of auditors. High is a nice word to use, maybe unrealistic in some cases. When you hear about these high-profile incidents such as the Wells Fargo, the first comment is, where were the auditors? So auditor expectations investor expectations need to be realistic, and at the same time, the standards need to be written so that it's very clear to the auditor what their role is in auditing non-conformance with financial measures. Independence and objectivity, I think, are the two things that are key. Investors do expect that. They expect their auditor to be divorced from management in the issue, and they also expect the auditor, when they discover material information, to report this information in a timely fashion to management, to the audit committee, or perhaps to the authorities. The PCAOB standards with regard to illegal acts is Standard 2405, which was written in 1989 and adopted by the PCAOB in 2003. So it is being updated. It doesn't reflect the world as we know it today. A lot of things have transpired. And we also, as a group, felt that the standard today is not strong enough. It needs to be strengthened in terms of defining the auditor's responsibility with regard to these issues. It also needs to enhance the steps the auditor needs to take. They must perform when they've discovered a material illegal act related to the financial statements. And what are our investor concerns? Investors are very concerned. We've had some high-profile incidents most recently, namely Wells Fargo. It's not clear. It isn't completely clear that it was a financial matter in the beginning, but a $1 billion reserve for liability and an effect on their reputation does impact the stock price. There is a financial effect. So investors expect auditors to detect these problems and report them in a timely manner. So our goal today is really to make recommendations to strengthen these standards as the staff goes through the review process. And what have we done? We've taken the comparative standards around the world and we've compared them to the PCAOB standard. I'll let Grant pick it up from here and talk about what our group did and what our recommendations are.
Thank you, Mary. Mary's covered it pretty well, so I'll just add a few points. One of the things that we wanted, Chair Clayton, to have you and the SEC staff have available to you is sort of the work product. And so in putting together our slide deck, we also had put together a comparative set of the standards from the PCAOB, the GAO Yellow Book, the sort of the statutory basis, and international accounting auditing standards and AICPA requirements. So I think that is a helpful document and hopefully helpful to the staff working group. As Mary said, we took our focus here through the eyes of investors. And obviously, I think like the audit reporting model and the CAMs, this is going to be something that's going to be a kind of a tough slog. I wouldn't anticipate that all the constituencies are going to say, oh yeah, let's just do a lot more and require the auditors. So, but we looked at it from the pure investor's perspective, understanding that there are limitations. I mean, you can't make the auditor the be-all and the end-all for helping investors and finding out everything. But what we thought we would do is try to, get a framework that the working group could go through. And Chairman Doty, going back to the Wells Fargo, which we really didn't want to make the focus of this because there's a lot of factors there, but there was a letter that came to both KPMG and the PCAOB from Senators Warren and Markey. And Chairman Doty's response talked about that, and he said late last year, the standard setting staff commenced a review of PCAOB standards specifically related to the consideration of illegal acts, and that they're weighing recent public events and observations from the board's oversight activities and considering whether the standards should be strengthened. And then he went through and said that we're going to take input from a lot of different areas, including this group, to help that staff working group get through their work. So I think that's important because, as Mary said, there is a lot of focus on this, and the question from an investor's perspective is clearly, frequently, where were the auditors? Why didn't people catch stuff like this? So what we did was reviewed the current requirements, which is Section 10A of the 10 Cap A of the Exchange Act, and AS 2405, which is the PCAOB rule, compared it to international and GAO standards with great assistance. Neither Mary and I are auditors or accountants. So, but we did have Lynn and Bob Trolla, who are highly expert on that, and the other members of the group who worked on this as well to keep us a little in bounds. We the standard has not been changed in a long time. I mean, this was adopted by the PCAOB at its founding, as I understand it, and it was a previously existing professional standard and has not been modified. So our conclusions basically are it's time to really take a close look at this. It's time to update it. The language is pre-SOX, pre-Dodd-Frank, but SOX being the most relevant there because of the things that SOX tried to address were not even in play at the time this standard was written. And that as we looked at the standard, the current standard, there are a lot of shoulds and not too many musts. And we think that sort of dichotomy ought to be looked at closely. We found that in some ways the international and the Yellow Book standards from the GAO are more stringent, and we think that the staff ought to consider those areas. And there are a couple of things, whistleblowers. There is no real focus in the current standard on whistleblowers, but in a post-SOX world, that landscape has changed dramatically. So we really think that that's part of what should be done. And then there's some other things that we have in there from the international standards. And so that's the approach we've taken, and we hope we've come up with some useful recommendations for the working group.
Well, Mary and Grant, thank you very much. And also thank you very much for the specific recommendations that you're putting forward today. I don't think anybody's under any illusions about how tough a slog this will be. But in reading your analysis of the comparison with respect to other standard setters and the fact that in this area the U.S. is behind the international community in many respects, I'm glad you're taking on this issue, bringing it to our attention, and I hope it doesn't take quite as long for us to address it as maybe some of the other issues that we've now reached a conclusion on. With that, let me turn it over to Norman on audit quality initiatives.
Steve, thank you. Good morning, everyone. Chairman Clayton, on behalf of our working group, I'd like to add our thanks and appreciation for your being here this morning. I think it's very important, and we know you have a lot on your plate. We appreciate your being generous with your time. Wes and Mark, as always, really important to have you here, and we enjoy this dialogue every year. I think it's important for all of us that you're here. I co-chair, along with my friend Lynn Turner, the working group on audit quality initiatives. And it's an interesting topic because if you think about it, audit quality is the foundational purpose for which the board was created. It's an express charge or mandate in SOX that the board was created to improve the quality of audit services offered by professional accounting firms. And if you think about it, everything the board does has that as its ultimate objective. And all of its standard setting and regulatory activities, its inspection and enforcement mechanisms, everything that happens here has the ultimate goal of improving the quality of audit services offered by professional accounting firms. And our working group this year takes that as our starting point and suggests as our foundational premise that, as is true in the private sector, we think it's true in the regulatory domain also, that you can better manage what you measure. And we believe that there are significant public and investor interests in the development of specific indicators of audit quality. There's a strong public interest in greater transparency regarding the audit process and the performance of audit firms. We believe that publication, measurement, tracking of AQIs would better inform the annual decision that public companies make about engagement of an auditor. Ann Simpson mentioned earlier that yesterday's action by the Commission is an important step forward for investors because of the additional information it provides to people like Ann and Amy and others who invest in a fiduciary capacity. We think very much the same is true of audit quality initiatives. The annual process of interviewing and proposing to shareholders the election of an auditor should not be a pro forma process. It is an election. And we believe that the audit quality initiative framework would provide important information for the people who are charged with proposing and electing auditors. In addition, AQIs could provide ongoing indicators and early warning signs of issues relating to auditor capacity, resource constraints, competence issues, And that, in turn, I think would better inform and serve as an important complement to the PCAOB's inspection regimen. And then lastly, as we point out and provide to the working group in an appendix to our report this year, the results of the PCAOB's own inspection process show that there's a lot of room for improvement here. That deficiency rates in your examinations of audit firms remain quite high, well north of 30%. In most cases, for some audit firms, for some years, higher than 50%. And that's, we think, very clearly room for improvement. And that AQIs, again, would provide an important tool in addressing that issue. We'll spend a little time during our presentation on the history of this initiative. It traces, as you all know, I assume, that the proposal to develop and measure audit quality initiatives was a product of the Paulson Commission report in 2008, which further recommended that if the PCAOB determined it to be feasible and that it promulgated audit quality indicators, that it monitor them, again, with one of the fundamental purposes to be to facilitate shareholder decision-making about the appointment of an auditor. The board's actions on this issue have a long and we believe unfinished history. First discussions of AQIs really relate back to 2013, when both the Standing Advisory Group and this Investor Advisory Group considered the issue. Many of us in the room this morning were on the working group back then, including yours truly. So we're glad to have an opportunity to raise it again. In 2015, the board published a very thoughtful concept release in which it proposed 28 audit quality indicators for consideration. Comments were due on that release later that year, and also in the fall of that year, the issue was discussed again with the SAG. And at least from the public perspective, the trail seems to have gone cold from there. So we're hoping that today in our discussions we can encourage the board to revisit and complete its work on this important issue with a sense of urgency, at least in part because, again, it's been 9 years since the Paulson report was published. And as we'll discuss during our presentation later today, audit regulators and professional organizations in other countries have been moving forward on this issue, and I think there's a risk here that we'll fall behind, which we certainly don't want to do. Specifically, we will have a number of recommendations to the board, again, to move with a sense of urgency to complete its work in this area. We'll recommend the proposal of a new standard that would require audit firms to disclose to audit committees their PCAOB inspection grades and identify the issuers with respect to which those grades were assigned. And we will urge the final adoption of a set of audit quality indicators that are supported by the investor community. With respect to the indicators themselves, we will spend some time today revisiting the work of the 2013 working group, where we went into this topic in great detail. I think the members of our group believe that those recommendations are as valid today as they were at the time, that a principal focus of audit quality indicators should be on, first of all, capturing data at the engagement-specific level and making sure that the indicators measure the outputs or the end results of the audit process, at least as much as they measure inputs. We'll recommend a number of priority areas for AQIs, including firms' compliance with independent standards. Again, as I mentioned, we'll recommend that the indicators require disclosure of PCAOB inspection results and grades to audit committees. We'll recommend that there be indicators that go to the issue of restatements and the frequency of a firm's undetected financial statement errors and internal control weaknesses. And then we do believe also that there are several input-oriented indicators that are important as well: staffing level, leverage, workload, professional competence of members of the audit team, things of that nature. We're also going to urge that the board expedite the release of its annual inspection reports. We've noticed there's been perhaps a little slippage on that front of late, and also that the board work to ensure timely release of the Part 2 inspection reports. As you probably know, Chairman Clayton, the Part 2 reports report to audit firms on instances in which the PCAOB inspectors identify weaknesses in the firm's internal controls over the quality of their audit process. And if the firm doesn't address those to the PCAOB's satisfaction within 12 months of the issuance of the report, that Part 2 report is supposed to be made public under the statute. And then lastly, we're going to, if time permits, we're going to encourage some discussion of some broader systemic or structural issues that we also believe have very direct effects on audit quality, independence issues and conflicts being one of those. We're seeing again, including most recently in Linda's home country in South Africa, the too big to fail issue continues to come up in conversation and in events. And lastly and fundamentally, some discussion of the overall efficacy of the user pays model and the inherent tension or conflict that creates, which undoubtedly has at least some bearing on audit quality. So that's a quick overview. And again, thank you so much for your time, Chairman Clayton. Steve, thank you.
Well, Norman and Lynn, thank you very much for your excellent work, and believe me, we all know that more work needs to be done in this area. And finally, to wrap up this session, Bob Tarola, you've done some work on digital financial statements, so turn it over to you.
Yes, thank you, Steve, and good morning again. First, I want to thank Steve for his leadership throughout the 7 years you said. I thought it was 8, but maybe it's 8. Yeah, yeah. I was there from the beginning when he dreamed this up. And it's been an honor to work with you and the rest of the members of the Investor Advisory Group. Chairman Clayton, I think you'll find that there's 2 themes that come from this group on a regular basis. One is transparency for investors, and the other one is enhancing the relevancy of the auditor. And I'm going to deal with a topic that's really emerging, and that's the auditor's role with respect to digital financial statements. Now that's code for structured data that's under the SEC's proposal to move information from human readable format to machine readable format in a way that is inseparable. Today the machine readable format is filed as an exhibit, so-called XBRL filings. Moving forward with the adoption of inline XBRL, that data will be inseparable. And indeed, I'll use my hand as an example. A person could read the front of my hand, and a machine could read the back of my hand, and there is no other information. I'll be proposing that the auditing profession and the PCAOB and the SEC look at how the auditor could add a quality element to that machine-readable information in order to protect investors and, again, enhance the relevancy of the auditor. I'll do a little demonstration on how that works in terms of the technology, talk about what's going on in the rest of the world with respect to the implementation of digital financial statements and the quality control over them. And also, we have some statistics on how investors are using them, and some investors around this table, Amy in particular, indicated that she insists that it be used by her analysts. So that'll be that presentation.
Well, thank you all very much, Chairman Clayton. I know that you've got to leave, but we appreciate very much your. Do
you mind if I save?
I wish you would.
No.
I was mindful of the clock, but take it away.
No. This is an important group, and I want to be respectful of your time and also react to where you are here. Before I do that, I want to say something about Wes and Mark and the work that led up today. I'm very happy to take responsibility because I know the quality of work that was put in here. And it's not just on the audit reporting, the auditor model, the CAMs, it's on the day-to-day work of the commission and everything that the Office of Chief Accountant brings to that. So I would be remiss not to thank both of you and not to let this group know what I let virtually everyone we meet with is that on these types of matters, I have complete confidence in Wes and Mark. And if they speak, they're speaking for they're speaking for me. So let me say that. On the topics that are before you, I want you to know how I look at these things. First of all, I think that the value of high-quality financial disclosure across the portfolio of public companies cannot be overstated. And audit quality is a part of that. the data set that provides to not just the investing public, but our economy as a whole is unbelievably valuable. And having had experience in many different markets, the level of confidence that is ascribed to those numbers in the U.S. markets is greater than anywhere else in the world. You know, when you benchmark, when you value companies and going to different metrics, you know, they drive company valuations, and whether it's in an M&A transaction or, you know, anything else, it's extremely important. With respect to the matters before you today, non-GAAP financial matters, unfortunate occasions where there are questions about non-compliance with law, and audit quality generally. For good or for bad, I have specific experiences with all of these in the private sector. And I would...
Makes you dangerous.
It does. It does. And I would encourage you to think, and I don't like to overburden them, but I would encourage you to dialogue with responsible audit committees and think about how the audit committee can facilitate moving forward. I recognize that financial reporting is not static. It needs to continually improve to reflect developments in our economy. These are the people on the front lines who are tasked with basically being a liaison between how management runs the business, which we all want to know how they look at the business, and how you comply with the reporting standards. So I would encourage you, as in your role, to dialogue with responsible members of audit committees, because I think they will not only better help you formulate your ideas, they'll probably better help you get them adopted, because they're the ones who have to live with them. So thank you for having me here today, and I really appreciate it.
Mr. Chairman, thank you very much. Well, why don't we wait for a minute or two and see whether or not the chairman returns in a timely fashion, and if not, we'll move ahead. And then I would also encourage everybody to think about their parting comments at the end of the day, because as in the past, we'll go around the table and ask each of you what you would most like to bring to the PCAOB's attention and to the attention of Wes and Mark. Actually, why don't we go ahead, Tony and Amy, and you know, get on with the fuller presentation, since we do have a certain limited time.
Thank you, Steve. Okay. I wanted to start with what we talked about last year, and the recommendations from last year. We initially, one of our recommendations was that maybe we should prescribe the definitions of non-GAAP measures or key performance indicators. But the concern there was that it's probably very difficult to come up with non-GAAP numbers that would fit all business models. So it's not really something that is easy to do. And even within a company that has more than one business model, we really didn't feel that it made sense to prescribe and therefore proscribe what they were doing. The second recommendation was to consider limiting the number and the use of non-GAAP measures. But the problem with this, of course, is the loss of information, because management tells us that they better reflect the way they run the companies. They reward their staff that way, and therefore it makes sense to allow them to continue doing that rather than limiting the use and the types of non-GAAP numbers. The third recommendation that we discussed was whether they should be independently validated through, say, self-regulation and so on. But it was really unconvincing that that could actually work if we left it to the self-regulating systems. Our next approach then was, maybe what we should do is require disclosure and presentation of the non-GAAP measures in financial statements to ensure that they're consistently calculated, the disclosures are uniform, and that they can provide us with the information. And therefore, of course, they would also have been audited. The problem was that it wasn't clear to us that the standard setters would be able to do that on a timely basis. Generally speaking, it takes the standard setters a fairly long period of time, long period to come up with these accounting standards and so on. And part of it makes sense because it does make sense to allow the public to comment on them, to have these discussions, roundtables, et cetera. So the concern was that the need is far more immediate, and yet it's not clear that the standard setters could do that. An alternative that we discussed was maybe we should require that non-GAAP measures be included in supplementary information and therefore could be audited that way. So that's where we left it. We had, I believe, a fairly lively debate last year, fairly extensive discussion as well. So here's what we want you to think about and what we'd like you to keep in mind today. So in essence, we find that the financial reporting models of both the U.S. and the international standard setters, whether we are talking about the IFRS or any of the other countries, significant players in the capital market, such as China and so on, whether they are providing or a leading role with respect to non-GAAP measures. And part of our problem with that, in essence, is very simple, is that they currently don't require these performance metrics. And obviously, therefore, those performance metrics that are available in financial statements are not audited. Now, the other side of that, of course, is the problem that management continues to argue, and they've been very consistent with this, that the non-GAAP measures, the key performance indicators that they use, better reflect the way they operate their businesses, the way they reward performance, and so on. And so from that perspective, clearly, we need this information. Management wants to provide it. But the fact is that there's a lack of standardization in the way they're defined. There's a lack of consistency in their disclosures. And when I talk about lack of consistency in disclosures, it's not just comparative information that can't be, that's not available. Even within a company, over a period of time, you don't get consistency. You don't have consistency in definitions. You often don't have consistency in the reconciliations. There are times when the reconciliations are not that straightforward to follow and find where the information is coming from. So effectively, keeping all of that in mind, we find that the proliferation of non-GAAP measures and the lack of adequate information about them is a problem. It's dangerous with respect to the capital markets, and I think from an investor perspective, that's something that is a very serious concern. I also wanted to point out that the validity, the value relevance, the utility of non-GAAP measures and entity-specific KPIs continues to be debated. There's an enormous amount of research, both academic and practical or practitioner research from the street, for example, and we provided a very extensive bibliography of all of this last year, and a little bit of that, and we've added this year as well. But the problem is that that debate has not yet settled anything. So it's not clear that there's value relevance. It's not clear that it lasts for any length of time. The other issue that I wanted to mention is that it certainly appears that non-GAAP measures affect market prices in the short term. It is also clear to me and to the team from observations that there are analysts and others who do use this information. They ask for the information as well. And as I pointed out last year, and will certainly emphasize this year, I don't want to give up this information. I need it because it gives me a window into the way management thinks. The question is, how do I get comparability consistency? And so that's the issue. The other problem that we've noticed is that the data aggregators require that analysts follow certain rules and make certain adjustments to their earnings forecasts. And if they don't follow those, then they're not included. And there isn't an analyst who would like that, and therefore the problem there is that if they emphasize certain types of non-GAAP measures without the consistency that one could get from a standard setter or a regulator, then it's unclear that those forecasts are helpful. And that emphasis that the data aggregators do on that may actually create more problems than it resolves for us. The next thing then is that there are issuers and there are some investors who focus on certain types of non-GAAP measures that are leading us down a slippery slope simply because of the types of adjustments that they either require and or condone. And that is also a very serious concern. And by the way, as I said before in my summary earlier, I think that the SEC has done a very good job the last couple of years working on this, on the comment letters and so on. Some of the more recent comment letters, just in the last few months, have been very, very helpful in pointing out, in asking very specific questions as to why things were left out, why they were defined in certain ways, or asking for additional clarity there. The other point I wanted to make was that it really is clear to us that both the regulators and the standard setters need to do more, and they need to find a way, particularly the standard setters need to find a way to provide the types of performance metrics that people are actually using and get some additional clarity on that. My next point then is that let's take a look at some of the recommendations. So our principal recommendation is that regulators and standard setters should get together, and then they ought to define these industry-specific key performance indicators, non-GAAP measures, which would then be audited for assurance. Given the concern that some of us have with whether that is actually possible, whether that falls within the remit of these standard setters, the FASB, the IFRS, an alternative that we're suggesting is that the standard setters and regulators should actually provide a framework. So they should tell us and require companies to follow certain guidelines with respect to display, reconciliation, disclosure, and provide that guidance for performance indicators which would be defined by management. Right? So if a company has 3 different business models and they want to use 3 different sets of non-GAAP measures, they're welcome to do that, because that does provide us with information. However, they have to be consistent. They have to be clearly defined, they have to be transparent, and they have to follow the guidance provided with respect to, as I said, location, display, presentation, disclosure, reconciliation. The additional recommendation that we make with respect to that is that the non-GAAP measures should actually be defined, as I said, by management. They should be transparently defined. And then once they follow those and they could be then audited. We also recommend that companies, once they've selected a non-GAAP measure, they should provide information for it for at least 3 years. Even if they choose after a year, let's say, to no longer provide that information, they have to continue providing it. So at any given point in time, in other words, if you use a non-GAAP measure, it would be very critical that you provide it for 3 years at a time. And therefore, that information gives the investors the trend information with respect to that non-GAAP measure. And the disclosures would help them better understand it. Okay. So we took a 2-pronged approach this year, and we've done some additional research on how investors and management uses non-GAAP measures. And that's the basis for the recommendations that we've developed here. Now, the non-GAAP measures and key performance indicators that are used by industrial and investment management, let's take a look at what they are. And probably the most common measure is some kind of an EBITDA. Everybody knows what EBITDA stands for, right? Earnings before interest, taxes, and debits that we abhor this year. And I'm sorry, it's actually. And the reason I say that actually is, it's not really facetious. The problem is that EBITDA does get defined differently from period to period. The debits that are adjusted change from one period to the other. And that inconsistency and the lack of transparency about that lack of consistency is the real problem. So what is it that EBITDA actually is used for? It's, as management tells us, that they use it to track and report performance. They also use it for acquisition decisions, and that's not just in the industrial world, even in the financial markets. The assets under management, very often companies tell us that's what they're doing. They're using some kind of an EBITDA or some sort of an adjusted EBITDA, some sort of an adjusted EPS. So very often, in other words, EBITDA, in addition to being a performance metric, is also actually a proxy for cash flows. Right? It's in a sense, it's a proxy for the cash-generating ability of the company. But here's a problem. If you are using capital a great deal, if you're asset intensive, if you have a lot of debt, then leaving out the demands of interest and the cost that you recognize as a result of depreciation and amortization, that certainly cannot help get a good sense of where things are. Stock compensation is another very, very common adjustment that companies make. But if you look at the companies that adjust, very many companies adjust for the stock compensation expense. A common argument is that it's non-cash. The problem is that they rely very heavily on stock compensation to pay their employees, to reward their employees. So it's very hard to see why that's not a relevant indicator of how they're going to do in the future. Companies that rely significantly on acquisitions to acquire technology, to stay ahead of technology needs, those are the kinds of companies that often adjust for the amortization of intangibles. And that, again, is a very significant problem, because you're leaving out the key indicators that'll tell us how you're going to do, what you're going to do in the future. The other problem, I think, is that there are many free cash flow proxies. Sometimes companies use revenue and EBITDA growth as metrics for measurement. Part of the problem, I think, the reason why companies opt for the cash flow or free cash flow proxies is that our cash flow statements are badly out of date. We still require companies, or allow companies, I should say, to use the indirect method. Both US GAAP and IFRS, as the IAS 7, were written a very, very long time ago. The Emerging Issues Task Force, which I'm a member of, has received more than 120 inquiries about cash flows in the last 12 years. 3 months ago, or 6 months ago rather, was the first time we talked about cash flow issues at the Emerging Issues Task Force in 15 years. So we've avoided talking about cash flow statements. And as a result, managers and investors are looking for other information about cash flows. There are some other problems as well. The indirect method that I mentioned earlier, both the US GAAP and IFRS will tell you that the direct method provides better information. But then the next line, they also, both of them say that you're encouraged to use the direct method. And I submit that if you look up the glossary for both standard setters, that both standard setters provide, encouraged is defined as you don't have to do this. And as a result, we don't get companies using the direct method. So I think that it's time the standard setters did something about that, because cash flow metrics are very, very important indicators of performance. Okay. The other issue that I wanted to mention is that investors and management are not the only users. Rating agencies tend to use non-GAAP measures as well. By the way, I acknowledge that rating agencies have periodically issued documents that, for example, a few years ago, Moody's published a paper written by their chief credit officer that was titled 10 Reasons Why You Should Never Use EBITDA. And however, at the same time, many rating agencies and rating analysts continue to use EBITDA as part of the work that they use and part of the information they use for credit ratings. Many credit investors use it. Banks use it for the evaluation, for example, of loans, credit lines. The U.S. Federal Reserve, as I pointed out last year, uses it to determine how much you can borrow in acquisitions. And I also pointed out last year, our research showed that although the Federal Reserve does have limits and says you can't borrow more than 6 times, there's at least anecdotal evidence that at the time companies make acquisitions, if you compared their EBITDA, the period immediately preceding the acquisition to the prior year, sometimes the differential was 3 to 4 times, or even more. So there's, in other words, there's a burst in EBITDA just around the time that you acquire other companies. And that allows you to then go out and borrow more money. So I think the Federal Reserve, one of our very key regulators, would also find it helpful if there was consistency in the way EBITDA was defined. The data aggregators and analysts, as I said before, the analysts who contribute to consensus earnings estimates, the data aggregators require specific definitions. And we really think that that exacerbates the whole issue because of the way they define it, because of the types of practices that they're effectively promulgating. And that, I think, makes it it contributes to the problem here. Okay. So some of our concerns fundamentally are that the academic and street research has rarely found value relevance or predictive ability. And a fairly recent study at, I think it was the American Accounting Association conference, found that very little relationship to value, but did find that non-GAAP financial measure users were companies that generally reported lower GAAP earnings and excess management compensation. There's a fair amount of research that shows that the differential between GAAP earnings and non-GAAP measures continues to grow. I know last year that some people noticed a slight decrease in that differential, but it's still fairly significant. There are others who have pointed out that, if you look at the stock market today and you think about PE multiples, you would be alarmed because they are at a high. But the problem is that when you look at non-GAAP PE multiples, they're significantly higher than what you have. So those are other areas or other issues why we have concerns as well. And then finally, I wanted to point out that there is selective reporting. So there are, at times, adjustments that companies make to their EBITDA or any other KPI or any other kind of non-GAAP measure. In fact, for example, I recall not too long ago seeing a couple of companies in the cloud computing world trying to adjust their deferred revenue amounts. And those are significantly concerning, the way they're calculated. I do understand, by the way, and I wanted to point out that the SEC does have a backlog disclosure requirement in Reg SK. I have said in the past that I wish they came up with a firm definition of firm orders. We don't have that at the moment. And if you're going to leave the definition that way, it would be great if you asked companies to tell us what their cancellation rates were, that sort of thing. I think that it's an important indicator for software companies, for IT companies. And I noticed that in 2016 you did start working towards that, which I commend you for. I think that, of course, there's another thing too. The new revenue accounting standard will require a disclosure of the transaction price that's included in performance obligations that have not yet been satisfied. So that's a type of a deferred revenue, type of a backlog disclosure. The combination of the SEC disclosure and the 606 disclosure, I think, are going to be very helpful. Of course, it remains to be seen how much information, what kind of disclosure we get, what kind of qualitative disclosure we get along with that information. And then finally, as I said, this one-time adjustment or the continued adjustment for restructuring charges that are designed to make core operations look more favorable or to show their performance better, we think that is significantly misleading. Right? And Amy, I'll move the slides if you like.
Okay, thanks, Tony. So the next slide really just details some of these material and unusual adjustments that may be made that Tony just touched upon. But really, these are generally, obviously, two-sided in most circumstances, and we feel we're really only seeing one side of those adjustments, the side that really impacts core operations, making them look more favorable, not necessarily the adjustment that would make them look less favorable. Wherein, for example, the supplier may adjust their financial measures, whereas the customer is not making the adjustment to their disclosures. But in actuality, it's potentially material to both. So we believe this practice is misleading and should be addressed. This is just some of the examples that we wanted to lay out for you. Tony touched on this a bit earlier as well, but generally speaking, companies are adjusting their GAAP metrics for recurring or essential expenditures, which, as analysts, we can potentially add back in. They probably shouldn't be taken out. They are potentially non-cash, but they're often real and impactful on a company's economics. So, for example, stock comp, interest and depreciation expense by debt and capital-intensive companies, and inconsistently defined and non-comparable use of restructuring charges. So these contain varying items from one period to the next and lack consistency in their disclosure. On the next page, there are already some statutes in place which should discourage this type of selective disclosure, such as the Exchange Act Rule 12b-20 and Sarbanes-Oxley Act Section 401. However, we believe these are still happening. So jumping ahead really to our punchline, which we've already alluded to, we believe using FASB-defined KPIs would restrict a user's ability to selectively disclose within their financial statements non-GAAP financial measures, which are material and unusual non-recurring items. Issuers would have to follow the defined rules, thus mitigating the use and risk of selective disclosures. So I'll just go ahead and detail our preferred path recommendation. As stated, we recommend the FASB develop and define new relevant KPIs, key performance indicators, to replace non-GAAP financial measures. These could then be included in the financial statements and audited alongside the rest of the financial statements. In addition, as just mentioned, all material, unusual, and non-recurring transactions should be disclosed in the footnotes of the financial statements to discourage issuers from using non-GAAPs to selectively report one-time items. Just to note, these 3 points are the most important parts of our recommendation, in my view. They allow for standardized definitions and auditing of them. If the FASB is unwilling or to create KPIs, then we believe potentially the SEC could consider taking up this project. On the next page, again, to reiterate the backdrop, investors generally desire these business-level metrics beyond what is provided using current GAAP, and we believe these metrics can be provided through GAAP-defined, non-GAAP financial measures and KPIs. As investors, we encourage comprehensive disclosures by companies and believe that there exist non-GAAP financial measures or KPIs which are relevant to our investment decisions. We believe non-GAAP financial measures and KPIs can be developed at the industry level, recognizing each industry's unique operating environment and relevant key performance indicators. these may more comprehensively incorporate the investor's desired metrics to review. Now, there was some feedback from the working group, which was very supportive and collaborative in our research project. But there was really some feedback from them that there's a lot of complexity surrounding developing these industry-level classifications, KPIs. And so, we researched this a bit, and we think that there's a possible consideration of using the Sustainability Accounting Standards Board roadmap, where they have worked to define industry categories from which companies can then choose which industry fits their organization. And they also allow conglomerates or companies with multiple business lines to report on multiple industry groups. So the SASB has worked at length to define industry groups that they believe are relevant categorizations, and companies can choose which ones they believe they fall into. And we think this is a roadmap from which the FASB could consider reviewing to develop KPIs. So once the FASB has developed these industry-specific KPIs, then the auditors would be required to test and give an opinion on those defined KPIs within the auditor's report. These KPIs should be audited with the same level of scrutiny as the rest of the financial statements. Tony, I'll turn it back over to you to discuss concerns.
Thank you, Amy. So, a significant concern with the FASB and the IASB developing the KPIs as our preferred path suggests. The problem is that the FASB in its current plan has not talked about doing anything with respect to non-GAAP measures. In fact, one of the more surprising things that I saw in the plan that they issued not too long ago, just a few weeks, I believe, is even their discussion of what they're going to do with segment reporting doesn't talk very much about this. They're not emphasizing the presentation document that they've been working on for very long. The IASB, on the other hand, has. They have actually proposed an EBIT measure. But they're not talking about doing anything with EBITDA or anything like that, or any other non-GAAP measure either. EBIT is certainly not one of those. I mean, it's actually fairly straightforward. It's right there. But they're talking about putting it in as a subtotal or requiring it as a subtotal. So given that concern, and also when you look at the revenue recognition standard, the lease accounting standard, and CECL, the credit loss standard, the three most recent ones, you'll see that the FASB and the IASB, the two work together to a large extent on these. I don't really think that they're converged, the three standards. There are substantive differences in recognition, measurement, and disclosure requirements across these three. And of course, we'll have to see what practice actually brings to us. But the point is that there is a common thread, and these are one-size-fits-all types of standards. So if that's where they're going, then expecting the FASB and the IASB to come up with industry-specific KPIs or non-GAAP measures seems at least unclear at best. Okay. The other problem also is that performance metrics, like non-GAAP measures, or at least the way they're characterized by management, these performance metrics are sort of analytical tools. And the accounting standard setters do not actually provide information. They clearly, I certainly understand, and I've always acknowledged that one primary reason for the existence of accounting standards is to provide useful information to investors, because that's how they make their investment decisions. That's what that information is critical. I realize, by the way, that social media is not all that conducive to providing financial information in bytes, right? However, the point is that it is useful information, but it is accounting. It's financial reporting. So the question is whether performance metrics are within the remit of the accounting standard setters. So if you keep that in mind, our alternative suggestion is that the standard setters and the regulators ought to work together to collaborate, and then they ought to define, in essence, the framework. So the display the reconciliation and the disclosure requirements for non-GAAP measures and KPIs. And those would also be audited, would then be audited. However, the measures themselves would be selected and defined by management. So that sort of takes care of the fact that you need individual and specific, industry-specific or business model-specific performance metrics. So I think having management define those and then provide that framework would be another way to go. At the same time, I think that it's also important to say or to require that companies provide these reconciliations and the information on any selected non-GAAP measure for at least a 3-year period. Right, so that we have the trend information that we need. And this includes, by the way, the disclosure requirements, includes the reconciliation requirements, all of it with respect to any measure that you've selected. Right? Amy?
Yeah, thanks, Tony. I think the only new information on this next page is really, based on just following up on what Tony is talking about, our interim path, our expansion of the audit. Essentially, we're recommending that the SEC utilize its authority from Sarbanes-Oxley to update Reg G and require issuers to disclose how they define non-GAAP financial measures. So explicitly define them to a detail that can be then audited, and then the PCAOB then requiring that the reconciliations from non-GAAPs to GAAP be audited based on each issuer's definition of the non-GAAP financial measures. We believe there are some benefits to this approach, consistency mainly, or disclose differences in reporting, and the ability to audit these non-GAAP financial measures. The audit then providing reasonable assurance that the numbers are accurate. We believe that requiring the 3-year look-back prevents firms from changing their non-GAAP financial measures from year to year without disclosing those changes to investors. We believe the audit and the detailed disclosure will be more useful to investors and may actually provide the framework and the information for financial modernization reporting initiatives such as the FASB and IASB defined KPIs. So one of the pushbacks on the FASB defining them is, what are the right ones to define, and this could help regulators get an insight into what companies believe are the most relevant key performance indicators to help with that project, potentially. So on the next slide, auditing of issuer-defined non-GAAP financial measures. Audit procedures already in place as defined in AS 1105 and AS 2701 could serve as a basis for this new audit standard. Reconciliations of non-GAAP financial measures in the financial statements and MD&A should be audited, and materiality should be measured relative to the GAAP metric on a line item basis. So lastly, we really wanted to touch on the earnings releases. There was a lot of really strong feedback from the working group on this somewhat gaping hole in our recommendations. There remain significant concerns by members of the group related to non-GAAP financial measures in earnings releases. The timeliness of earnings releases makes auditing these prior to release potentially undesirable in that some investors are clamoring for their release sooner rather than later. However, some investors admittedly do react to earnings releases, so this is obviously a potential risk and area of inefficiency. So as such, we recommend consider requiring a reconciliation to GAAP of non-GAAP financial measures used in quarterly earnings releases as a footnote to the financial statement, knowing that that footnote with the reconciliation of the prior quarterly releases will be audited may mitigate poor disclosure in these currently unaudited releases. We understand this is a very difficult issue for regulators to solve, but is also one of the most important related to non-GAAP financial measures due to their prevalence in these releases. So I guess that sort of concludes our formal presentation. There's obviously a lot of issues we discussed within the presentation, but our overarching message is that investors want defined non-GAAP financial measures that can and will be audited. That's the punchline.
Well, that raises a large number of questions, but before we go to the break, Bob, why don't you briefly go through your presentation slides, then we'll take a break, and then we'll open it up to what I envision to be a fairly significant discussion.
Tony, if you could pass the slide advancer, please.
There's the advancer.
Okay. Okay, thank you again. I'll try to go through these quickly, Steve, so that we can stay on time. This segment focuses on the changes in technology for business reporting, including how financial statements are prepared, and makes a case for auditor assurance to promote continued trust in the information available to investors. As technology advances to allow investors to access financial statements in a structured digital format, it's important for that information to be subjected to the quality control system that the auditing profession represents. Today, the digital financial statements are outside of that system. We will argue and propose that it come inside in the interest of protecting investors and enhancing the relevancy of the audit. Technology is driving change in financial reporting. For over a decade, the SEC and many other regulators around the world have used extensible business reporting language, or XBRL, to standardize information for market participants. I was one of the early implementers as a CFO participating in the SEC pilot program. It was clear to me that this reporting standard offered dramatically new capability in gathering, reporting, and analyzing business information, including benefits for preparers, regulators, and investors. But, and this is a big but, because the digital financial statements are not official, they are filed as an exhibit or furnished as an exhibit to SEC filings, auditors have been missing from the equation. Today, again through the vision and leadership of the SEC, the use of digital technology for business reporting is moving to the next level. That new technology is called inline XBRL, which combines the human-readable information with the machine-readable information into one data element. Thus, there will no longer be separate documents submitted by registrants. There will be only one document. And that presents an opportunity to leverage auditor capabilities to foster trust in digital information becoming widely used by investors. The protection of investors is paramount and should not be any less important if they obtain information digitally. Investors rightly expect digital financial statements to be subjected to audit. Indeed, they are surprised that it is not now the case. This is not theoretical or future-looking. A full 50% of CFA members believe digital information should be incorporated into the standard financial statement audit. So let me give you an example of how this works. This is right out of the SEC test example of financial statements under inline XBRL. You'll see that it looks like a normal balance sheet, except for those orange underlines. If we click on one of those, we'll see what's being disclosed. Underneath that number is a data tag. And that data tag, in this case, is actually 4 layers. It could be even more layers. But it discloses what's been tagged by the issuer. The information is machine readable. The tag includes a wealth of information, such as value, currency, reporting period, and links to authoritative literature. And if you can think in a forward-looking way, it can also contain an auditor imprimatur and link the audit guidance reference to reported critical audit matters. So it can be, that tag goes with that number no matter where it travels, whether it travels into an analyst's investment model or into any other data set. The problem is that the front, if you will, the front of my hand is audited, whereas the back of my hand, the one that's machine readable, is not now audited. I also want to point out the power of this technology. If that graphic shows that the dollars spent on share repurchases by quarter. This information was gathered almost instantaneously from structured information available from the SEC. If this were not the case, you can imagine taking hundreds of hours, if you will, to collect that kind of information. So it's a very powerful tool. Let me also describe the worldview. I want to emphasize that the digital transformation in business reporting is a global phenomenon, and regulators around the world are expanding its use and debating the quality control system that needs to be in place. The SEC is not alone in this shift to inline XBRL. Avoiding so-called dual filings and having one financial statement that can be both consumed by systems and read by people makes sense to policymakers and major regulators around the world. In my role as a board member of XBR International, which is a U.S. nonprofit that owns and freely makes available these standards, I have observed that the security regulators in Europe and Japan are following the SEC's lead. The acceptance around the world of digitized reporting begins to mainstream its use. This statement points out that users want independent assurance over digital financial statements. The chart points out that those involved or currently use digital information furnished by registrants want assurance that it is correct information. An excerpt from the comment letter on inline XBRL from the American Institute of CPAs reads, "Users are very likely to incorrectly assume that such information was subjected to procedures by the auditor." And then the AICPA goes on to say, because it may be more efficient for auditors to perform procedures on XBRL tags in conjunction with financial statement audit, it would be helpful for the PCAOB to develop standards. So in summary, digital business reporting is here and will continue to evolve. We can expect that every market participant will expand their reliance on these filings, both directly as well as indirectly through data providers who already source their information from XBRL exhibits. Ensuring that registrants' digital disclosures match their human readable ones is a vital part of maintaining accuracy and confidence. The expectation of investors is that all information provided by registrants under the SEC disclosure system is correct and can be trusted. The relevancy of the audit is at stake if this expectation is not met for digital financial statements. I'll end there, Steve.
Well, thank you very much, Bob. And I think both presentations raise a number of issues. And so why don't we take a 15-minute break, come back at 5 after 11, and then open it up for discussion. Moving ahead. All right, why don't I start with the first softball question to Tony and Amy, and that deals with the short versus the long-term orientation of investors. And given the short-term orientation of so many of today's investors, my highly simplistic, basic, fundamental question is, how would you compare the importance of GAAP versus non-GAAP measures in their decision-making? Which one is more important, why? And aggressively, if you would, reiterate the answer to the question that we're always asked by the Commission and others: what exactly is the need and what's the problem that we're seeking to address?
Do you want me to kick it off? Okay. So thanks for the question, Steve. I think it's a relevant one. I think that in general, non-GAAP financial measures are viewed as maybe more of a short-term investor phenomenon, wherein shorter-term investors are reacting to those measures in earnings releases, such as the non-GAAP financial measures that we've talked about today, whereas potentially the perception is that longer-term investors are not really paying attention to those, as they're not reacting to quarterly releases as much, and as such are more focused on GAAP metrics. I think that In general, there is a lot that's said about short-term investing, but I think long-term investors use non-GAAP financial measures as pieces to the overall investment puzzle, part of the mosaic that goes into the long-term investment decision. So I, as such, think that they are important to both long and short-term investors. And I think that any sort of quarterly releases or short-term phenomenon in a company and or a stock create that long-term path. And so I think it's important to both long-term and short-term investors and shouldn't really necessarily differentiate the need for non-GAAP or the relevance of non-GAAP financial measures for both types of investors. As it relates to the ask, I think, just to reiterate, we're asking for clearly defined non-GAAP financial measures that can be consistently and make comparability amongst companies, facilitate comparability, and we would like those to be audited just for assurance of appropriate and proper calculation of those numbers.
Steve, may I?
Yes.
I remember I had just started serving on the faculty at New York University when some research was released, academic research that showed that there was very little market reaction to the release of the annual report. And a lot of people were talking about, at that point, this was 1980, and they were saying that, it suggests that GAAP is really not useful. And I remember reading an analysis by another researcher, actually the chairman of our accounting department, George Sorter, who pointed out that what investors are doing, short or long term, is they have a model. They look at a company, they think about what it's going to do, and then the information that the company releases, quarterly, annual, GAAP, non-GAAP, all of that information is then taken in, and then the investor determines whether they need to adjust their model. So from that perspective, I think that I prefer to think of it as being information that's going to tell me what I need to do about my own understanding of that particular company.
Ann Simpson.
Thank you very much. And thank you very much to the working group and to Tony and Amy. There's an excellent piece of work. I wanted to flag that I think this question about non-GAAP measures is one sign of a bigger shift of what's going on in the economy, which has quite profound implications for corporate reporting overall and thereby for the role of the auditor. I want to flag, as many of you know, CalPERS was one of the signatories to a petition to the SEC recently asking for a roundtable looking at how companies could and should be reporting better on human capital. And, one of our observations is that we've got sort of 1970s reporting for an economy that in the meantime since then has been quite transformed in quite dramatic ways, as Bob was saying with the digital reporting. So, just as one data point, in the early 1970s, the balance sheet was 85% tangibles, and it's now about 85% intangibles. So this question about non-GAAP reporting, I see it in part as a way of companies scrambling to communicate to the market what the drivers of value are, and for us also what might be the sources of risk. So I'd like us to maybe put some bigger economic context around this when we're thinking about it. One other example on our mind at CalPERS is the Financial Stability Board's recent recommendations through its task force regarding financial-related climate change disclosure, of which there are several categories of risk, and they rightly say opportunity. We're encouraging companies strongly to pick up this framework and start reporting, but how it's going to connect in with the audit committee oversight, what the role for the auditor might be on these data points is an open question. So I guess my comment is, thank you for the work. My question is, could we expand it to start looking at the real nature of the economy, the real nature of what drives corporate business, because I think that poses bigger questions on reporting and audit. So that's my big question, if you like, and maybe you thought about that one. And a specific question is, what in this realm of improvement, because we don't want to constrain and stifle companies in reporting, that would be really a backward measure, backward step. But what could or should be the role of the audit committee? Because on the investor side, there's the capital allocation question, which is rightly remembered, but I do want to flag that share owners like CalPERS, which are large and long-term, also take very seriously our voting responsibilities. And in this sense, we're looking at board quality, we're voting on audit committee members, we may well be ratifying, often ratifying the appointment of the auditor. So the question of how we can improve our own responsibility for stewardship, I think, is relevant. So thank you for the work, and a big question and maybe a smaller question for you. Thanks.
Kevin Chavers.
Thank you, and I'd also like to thank the work that Amy and Tony have done on the committee. I'd actually like to sort of reiterate or associate myself with the comments that Amy made about the sort of the dichotomy you posed in the question between sort of long-term and short-term investors, and suggest that these indicators are as equally as important for people who focus on the long term. If they provide, sort of feedback and also indication of long-term value, and frankly give you some indication about management and evaluation of management's stewardship, if you will, of creating value in those enterprises. I'd also like to sort of pick up on what on Ann's comment. We didn't sort of focus within this context because it was more narrowly defined on non-GAAP financial measures. But I would respectfully submit that some of the same challenges, even though it is more sort of emerging, are applicable as we begin to look at sort of ESG indicators. And I thought it was instructive that one of the parallels suggested in looking for some standardization by industry was to look at some of the work that SASB has done, but also to incorporate that burgeoning group of metrics along sort of the ESG indicators as indications of long-term value creation and how to think about those and bring standardization there. Again, while not directly in the scope of what the working group, it strikes me that it makes a lot of sense for the group to perhaps sort of look at that going forward as well.
But I don't sense that there's any SASB-type equivalent that's looking at these issues. What's the process moving forward in terms of addressing the issue? And with respect to, industry-specific criteria, how do you envision that being set if it's not set by the FASB? I mean, what's the mechanism for moving ahead with what you're talking about? Mary, I didn't mean to cut you off. Keep it up. All right.
Steve, frankly, I guess I'm naive to the actual process. We made the recommendation that the FASB consider defining industry-specific KPIs. If they're not willing to do so, maybe the SEC could take it up as a project. I think, first and foremost, I'm happy to be a part of the conversation in whatever way you think is the appropriate path forward. I think it's important that I think each of the groups have working groups just like ours working on this particular issue, and I think we could all benefit from collaboration and sharing of ideas. Maybe it's going on and I'm just naive to it on the staff level. But I think that, start now, if it's not already started, and start the collaboration working together to come up with a common solution that is feasible to all parties is the right approach. But Tony, you may have some better ideas.
No, just different. I don't necessarily see the issue, as I mentioned earlier, the problem is can a standard setter necessarily come up with a set of indicators that everybody could use? I'm not convinced of that. I think, therefore, I've said that I think we should allow management to do that. But we do need to provide a framework within which that information is presented. And that, once it is presented within that framework, it ought to be audited there, in that framework. So display, reconciliation, definition, disclosure, definition requirements, and so on. And we've, at the CFA Institute, we've often spent our time trying to figure out where do we draw the line between accounting and analysis? And what is it that we think the FASB ought to be doing as a standard setter, or the IASB, and what should we look for from management and so on. And I think the other problem I have is that I really don't want to curb management's providing me that information about how they think they're running the company, what they feel is important. And I really don't think that it's going to be possible for us to come up with, or for a standard setter to come up with that sort of thing. And I sort of, in a sense, I'm in both camps, because for the last almost 18 years, I have been part of the standard setting process, starting with the ACSEC, continuing with the Emerging Issues Task Force, even though I clearly, I spend my time there representing the investor, and I'm interested in understanding what the numbers we're asking them to provide are telling us. But at the same time, with respect to non-GAAP financial measures and or KPIs, and I could expand the argument, although, I'll take Kevin's point that this was very narrowly defined, and so let me stay with the non-GAAP numbers. I find it difficult to see that the standard setters will be able to do it. And as I said, I don't really have evidence right now that they're working on it.
Right. Linda de Beer, South Africa is taking quite a enlightened approach to ESG and integrated reporting. And so we welcome your comments on this subject in relation to what you've done or otherwise.
Thank you very much, Chair, and thank you. I thought the document was really useful to make me think about a lot of things, and it's useful that it's the second year in a row that we're discussing it. I think it's important to take a step back and consider what the objective is, and I thought Anne put it quite nicely to say that investors are looking at the ability of an organization to create sustainable value, which is very much in line with the integrated reporting framework objective, by the way. So I guess the question then is it possible for FASB or any other standard setter to come up with a so-called silver bullet of these are the 2 or 3 indicators or one that will actually give investors that answer? I'm not convinced that a single indicator can do that. In South Africa, for about 15, 20 years, we had this concept of headline earnings per share, which was originally started in the UK. And our listed companies, our public companies, have to disclose the number. It's a very, very rules-based number, because that's the only way in which you get that level of consistency. And what it basically does is it splits what we refer to as the platform, the engine room that creates the value, from the value that it creates. So headline earnings is really that sustainable, hopefully sustainable value creation or profit or earnings number. Having said that, despite that, companies want to disclose lots of other things because they know that that single number is not necessarily giving investors what they want. I would be very concerned if, sitting as a chairman of an audit committee, if we are boxed into a standard setter telling us which KPIs to disclose. I'll give you one example. I'm on the board of a property company. Now, there are 20 or so other property companies in that specific sector, listed in that sector, but they're all very different. So we hotel owners, but we hotel owners that use other operators. There's no one else like us in that sector. There are other property companies in that sector that are in the retail space, shopping centers. There are companies that are in the commercial space, office space. How do you develop as a standard setter KPIs to indicate value or earnings or whatever the appropriate measures are across such a wide spectrum in a single sector? I think Anne's point, I thought, was very valid, that you want to not stifle, you want to make sure that there's adequate freedom for companies to do what they have to explain their business model, which, by the way, also changes over time. So you might actually, over time, do want to change, and I think the suggestion to keep some of those KPIs for a while just to avoid manipulation is sensible. I think the value that the PCAOB can add is how do you deal with making sure that whatever they choose to do is reliable. The audit aspect of it, I think, is quite important, and the disclosure aspect. And I think therein standard setters have a very important role to play, is make sure that there's proper reconciliation back to the financial numbers, that there is proper disclosure of the definitions of how numbers are determined. But to say, you know, even within an industry you all do this, I think that's difficult and problematic.
Tony?
Yeah, thank you, Steve. Linda reminded me of another aspect of this. Just to give you a sense of what she was talking about, the property management or property type of companies, is a particular class of those is in the U.S. is called REITs, the Real Estate Investment Trusts. And I find it fascinating because I was thinking about them not too long ago, and data center REITs are competing, in a sense, for attention in the marketplace, while you're talking about these property REITs, the ones that own malls where people are leaving, the stores are walking away from them. But data center REITs are growing differently. Is it really going to be possible for somebody to say that for a REIT, this is the way to look at it? So I think from that perspective, it's very, very important to keep in mind that it's not going to be possible to do that. But another point that Linda makes and Ann made earlier is, as I said also in 2016, one of the things our teams had said was that we really don't want to stifle management. We'd like to encourage them to provide this information, but what we want is some kind of a framework within which it is provided. And I do worry about auditing these because if, for example, I believe that a particular non-GAAP financial measure is misleading, then does having it audited make it any better?
Mike Head?
Not to repeat what everybody else has just said. One, I think we've just said why it's going to be virtually impossible to define the KPIs and the metrics outside of management defining them. I think that's almost a foregone conclusion because of what everybody has said. I'm a little pragmatic about this in that and to add, audit committees already are responsible for approving the earnings releases before they're released. So we're not talking about management review, board responsibility, audit committee responsibilities, all limited quarterly reviews, all that stuff is there. We're just saying the metrics aren't being subjected to audit procedures, and that's a risk that we think is too high because of how they're being used by the investors. I don't see any way out of this without making the management defined metrics as they define in their terminology listed in their 10K. They're there already. They have to be. They have to be disclosed. Incorporating them like we went the direction with segment reporting, it maybe even could be an expansion of segment reporting, but incorporating them as footnote disclosure that automatically requires auditors then to audit it. If it's a footnote, it has to be audited. And therefore, the framework, the display, the reconciliation, all that format being defined by the SEC as enhancements either to segment reporting requirements or as a separate disclosure in the footnotes, and then automatically then all the audit requirements are already in place. Right. They have to audit it then. Maybe that's way too pragmatic, but that's the way I would go.
No,
So Mike, just to close the loop, what do you see as the next steps that you would like to see from the SEC, FASB,
if
or
I was
us?
king of the world, and I would ask our partners at the SEC to seriously consider making the disclosures in a standard format, either part of an existing footnote or in a new footnote, issue that, go forward, and then the auditors have to audit it. Now, I make that sound real simple. I know it's not, but that's where the power is. That's where the leverage is. That's what gets it done quicker versus slower and gets it out of the academic, intellectual discussions into something that can be acted upon, in my humble opinion.
Lynn Turner.
I think some historical perspective is helpful here, because this is an issue that's been ongoing for over 3 decades. It's really got started with the REITs, with their funds flow from operations back in the 80s. And by the time I was back at the commission in 98 to 01, the non-GAAP stuff had taken on a life of its own and gotten fairly bad. At that point in time, I knew it when one morning I woke up and read a public high-tech company's non-GAAP disclosures, and they had subtracted out all marketing costs, just taken the line out. And, you know, they looked a lot better when they didn't have to include any of their marketing expenses. So, but it's taken on a life of its own now, and I actually think it's grown much worse now than even how bad it was when I was chief accountant. As Tony mentioned, the multiples are definitely being impacted, and as I read analyst reports and see what's going on, it's very clear that Wall Street and the companies are using the different measures to justify higher valuations than what are probably realistic for companies. In fact, I saw one yesterday, it had something like 91 non-GAAP items in its reconciliation. So they're being used for a very bad reason that I think is actually going to have a worse outcome than what was here when we had the dot-com crash. At that point in time, the inflated valuations were occurring when we had a 4.5% GDP growth rate. Now the GDP growth rate's only 2%, so the likelihood of higher risk and a worse outcome are very, very real today in today's market. And once investors sense that there's trouble and start to pull the money, we'll find out just how big that risk is, because as money rushes in, money also rushes out. As I look at this, so in '92, the AICPA had a project to look at this type of reporting called the Jenkins Report, and they came out with a report about '96. And then the FASB followed on with what they call a business reporting model, which actually did get into KPIs. If you go back and read it, it does have KPIs for specific industry. And the FASB showed and demonstrated an ability in that report to reach out to industry, bring in industry task groups, which helped them define the KPIs by industry. So I think they clearly demonstrated an ability to do it. Their problem was they publicly announced at the time they did the business model, which the FEI absolutely didn't want them to do. They announced publicly that they'd reached an agreement with the FEI that when they did the project, they would not go into standard setting afterwards and adopt any standards surrounding it, which was a very, very bad policy decision. And I don't think the current board is in any way fenced in by that. And I think the FASB has demonstrated they've got the ability to go bring in the expertise and the industry groups to develop those standards. So I think they've done the work, they've got a good foundation. I've been a CFO. Every one of these industries, I was in the semiconductor industry, we all knew what the top 6 were. and we all knew how we defined them. And you will, if you look at them, there's usually an outlier in each industry where people have gone off the deep end in how they define it. And it seems that's where the problem is. No one's really in the slides. We didn't define what the problem is. And as our friends at the SEC have said from time to time, the first thing we should do is, let's go define the problem and then try to find the solution. What is the objective, as Linda said, that we're trying to get to here? And so I think the problem, as I listen to people, is that, one, they don't trust management and how they've determined which ones will or will not be in, and have kind of pick and choose them. Well, if I have a problem trusting management to start with, I'm not going to trust them to define them. I mean, that's kind of going to take you down. Yeah, fuck yeah. Some would say that. Yeah. So I'll say it then. But yeah, so I think the FASB is the right group. If you don't trust management, they're a group, and I think they can do it. I think they've proven that they can do it. At the same time, since the FASB seems to be dinking around with all their resources on improvement projects, which don't do a whole lot for investor protection, maybe the SEC then, in the meantime, waiting for them, needs to go in and require, as Amy laid out, that since management are picking and choosing them these days, at least have management disclose how they defined and what determined which ones they did or did not pick, and, quite frankly, whether there were other large non-recurring items that, they forgot to leave out of or put in the reconciliation. So I think that would be good disclosure, and perhaps even a red herring on top of that that says these results don't necessarily reflect the actual business results for the business, because they are there's no question they're picking and choosing what they put in there, and they're doing it to support inflated valuations. So I think that would be a good move. Ultimately, Tony is right. The problem here is the FASB has got a horrendous cash flow statement. They went and did that project many years ago, over 2 decades ago now. The investors at the time told them they weren't going far enough. Nothing's changed. The investors are right then, they're right now. And ultimately, if you're going to fix this, this is about the long-term cash flow generating capability of the business. And the FASB could do if they wanted to do a real improvement project and get serious about serving investors and investor protection, they could very quickly go in and modify the old Statement 95 to say you have to use the direct method of cash flow. And that would solve most of these problems. And it could be a very short-term, limited improvement project, because all they have to do is change one sentence in that statement that says you have to use the direct statement. And that's where I think they need to go. And the KPIs would be a good project, because if you know those 6 or 8 key performance indicators, if I laid out the 6 key performance indicators for me at this semiconductor company, I could tell you almost to the penny what the next quarter was going to be, and I could tell you certainly to a very small number what the next year or so was going to be, and it's true for each of the industries. So having the KPIs is very valuable information, but it's only valuable if they got the right items. And I have actually seen cases where auditors audited and tested and gave a report on non-GAAP disclosures and reconciliations, and they just missed it hugely, and it cost investors a ton of money. So the notion of you going to have an audit, if they can't do any better than what they're doing with the regular financials, and we've seen not only in the U.S. but around the globe now a 30 to 40% defect rate from following gas. If they can't do any better than that for me, I'm not sure I want to get the false assumption that the non-GAAP numbers can be trusted when they've got that far an error rate. So I'd like to see them show me they can improve on that before I turn around and spend a lot of money having the audit on this area, because at 30 to 40%, I don't trust the numbers.
Mike Smart, I know your 10 card's been up and down, but having said that, even if you repeat what's been said by others here, I think it's important to get whatever you want on the record, because Wes and Mark, we know that this area is not specifically directly targeted within our jurisdiction, but when we went out and vetted the subject matter that we wanted this group to talk about, virtually everybody here said that they wanted to talk about non-GAAP. And so in terms of the working group, there was a resounding majority that thought this issue ought to be brought up. So, Michael, I'll turn to you, and then Mary and Tony.
I'll be brief because my card's been up and down because many of the points I wanted to make have been made emphatically in some cases. But from my perspective, I think that a standard could be set either by FASB or at the encouragement of the SEC as it relates to specifically EBITDA. I think most of us in the room who are long-term investors or investors in general, we all use that measure to a very large extent. It can vary from industry to industry, but it's pretty much a baseline. And I think that if that baseline could simply be standardized, that's sort of the foundation that all these adjustments can be built upon. I was discussing with Amy beforehand. When they lay out the adjustments, and this is sort of coming from management and the comment, the fox in the hen house, when all the adjustments are put on top of that baseline, at least we know exactly what that baseline is, and if we want to fall back to that as institutional investors, we can fall back on that. That's an audited number, and that if we choose, that can be the basis of our decision making. I think it's also important that all the respective adjustments that are put on top of that baseline be laid out succinctly and explain what exactly do they entail, what exactly why they're there, and why they're being added to this baseline number. I think that if we could have some movement on that issue, I think the fact that 90% of investors are looking at EBITDA, but EBITDA is not an audited number, I mean, it doesn't quite make sense to me. And this has been going on for years and years and years, and Amy will tell you, we know what some of the adjustments are, and we can decide whether we want to accept those adjustments or not. But at the very least, we have a baseline issue there, a baseline number there.
Thank you. Mary?
Thank you, Steve. I want to go back to your first question, which was long-term, short-term. Right. And from an investor perspective, I really think long-term investors, and I think most of us are long-term investors, know our companies, and we can look at some of these KPIs, some of these adjustments, fairly realistically. It's the short-term investors, it's the technical analysts. Anyone under 34 years of age today doesn't even remember the last downturn. So we have a lot of short-term reactions to earnings announcements, and I use FactSet, and a lot of those announcements are basically the non-GAAP number. You have to kind of dig to find that GAAP number. And I personally take advantage of that volatility around those short-term numbers, and I think long-term investors who are well-informed can. That said, I want to go back to the ESG, and I think we're getting more pressure from clients to consider these factors. They want us to be thinking about these factors. And going back to earlier comments, and that I think reflects the changes in our economy. I mean, we are evolving, and companies like Hewlett-Packard don't know whether they're hardware or software. So I do think we have challenges ahead of us, but I do think if a company can say, these are the key performance indicators for our company, they stick with them for a few years. I love that concept. It will give the long-term investor more of a basis for understanding the company. The short term, I think we're overstating earnings. So when people talk about next year's earnings, PE being at 18 times, I'm not sure that's really true. I'd like to see the GAAP number be used in that PE ratio. I think we'd be faced with a far more overvalued market today. So I think you do have this dichotomy between the old and the new, and the short term and long term, the fundamental investor, the technical investor. I don't know if this project will solve the problem, but I do believe it will make managements more consistent, and I think it will help for all investors to understand what the metrics were that are being used to evaluate these companies. So I really like your question about short-term and long-term. I think it's a real issue in our markets today. Thanks.
Good, thank you. Gary Walsh.
Yeah, there we go. I was prepared to talk about the difference between the KPIs by industry, and then I was also prepared to talk about the differences between growth-oriented KPIs versus value-oriented KPIs. And what I wasn't prepared to talk about was some of the things that Ann and Mary have talked about, and now I realize there's a difference between California KPI interest and Texas interested KPIs. So had I listed 500 different KPIs, I wouldn't have come up with some of the things we've heard, and it just brings to mind that I think it's going to be impossible to come up with a group that everyone is going to center on. I also worry about having KPIs that are management directed, and but I think that's a better step. And the one thing that I'm really drawn to is having some consistency. And so if management were to lay out their KPIs and they were to be consistent with things, I think that moves the ball forward, and that's an enhancement. I think that we're all longing for more consistency and a reduction of the selective selective metrics that management teams are using. So,
if management does it on an industry by industry basis, how's their comparability? How do you ensure comparability between the KPIs?
I'm sorry, if they do it by industry?
Yeah.
Even that doesn't get you there, because I was just looking at I'm responsible for the telecommunications sector, analyzing those stocks for my firm. And that's a very narrow, small part of the S&P, really only 4 investable companies. Each one of them have a different set of metrics that would be necessary to fully appreciate what's going on with their businesses. So I don't, if it's that difficult with that narrow a group of companies, I don't think you can do that broader. So, but having each one of those management teams say these are the I don't know, 5, 10 metrics that we think we're managing the business towards, I think that gives you more insight than what we have now.
Robert, Bob, Tarola.
Yes, thanks, Steve. I'd like to put a plug in for audit committees. The
chairman of the SEC just earlier did.
Well,
please go ahead and value add.
Yeah. So let me tell you what comes before an audit committee. The earnings release will come before the audit committee. Someone said it must. I don't think it is. I don't think it is a must. I think it's basically company practices. That release likely will contain a whole slew of KPIs and non-GAAP measures, because the audience for that earnings release are the current investors of that company generally. And those current investors are telling the company, here's what we want to know. Here's how we value you. Here's how we report on you. Here's how we analyze you. And if you read their analyst reports, that's basically all they talk about are those KPIs or non-GAAP measures. And then you go to the financial statement audit and the filing of the 10K, and those measures are nowhere to be found. So the question, I think, on the table is, are these measures relevant? Some people, I think, are questioning the relevancy. And then the other question is, whether they are or not, should they be subject to some quality control process? I think investors are indeed defining what they want to know. But it's outside of the quality control process. It doesn't get into the 10K. It doesn't get into the audit cycle. In fact, audit firms generally gloss over when you're talking about non-GAAP measures because it's not in their scope. So connecting the two, I think, could be a big win for investors, particularly to make sure that what they think is important is indeed subjected to some validation by an independent party, and let investors decide what they want to know.
Lynn Turner.
Steve, I'm not sure about your question. You seem to be asking if wouldn't all companies have the same KPIs and whether or not they'd be different by industry. Is that your question?
Well, there's a variation on the theme. First of all, I look at the SASB model. And in terms of the SASB model, there's no equivalent model that I see in this area. And so if management is setting the KPIs, how do you ensure comparability with respect to various issuers in the various setting of management KPIs?
Well, let me respond then. First of all, KPIs are different for each industry. What drives a business to be successful, the critical success factors for each industry are significantly different. They can be very different within an industry. The high-tech company that I managed had a lot of fixed plant, large semiconductor manufacturing companies. Our KPIs were different than a semiconductor company who operated by outsourcing all the manufacturing at the time to someone, and night and day difference, because a lot revolved around not only the R&D, which was the same for both of us, but in terms of utilization of that fixed asset that we had, that was major difference. So our KPIs, even though we were in the same industry as another semiconductor company, may be different. And you're going to have that with every different industry. For car companies, if you go out and look at their website, they'll give you the top KPIs out on the website in terms of production and what they're running through the plants and what they got out there. Retail does the same thing. If I look at the retailers, absent Amazon, the biggest one, they will turn around and give you sales per square foot, sales per register, that type of stuff that are key to those. So they are different, and it is not a SASB type model. Do not expect it to be a SASB type model. That's a false expectation, and the two won't be the same. As far as quality control goes, I agree with Bob that it'd be nice to have some quality control, but if I'm going to have quality control on a digital information check, I'm not sure I would use our independent CPAs for that check. I may very well go to some type of organization that spends and has a lot more competency in terms of computer programming and the ability to check those numbers as they translate from one in the other electronically. And that's not our CPA firms. As we've seen recently, they're not top-notch on cybersecurity. I would not go to them for cybersecurity. And if that's the case, I'm not sure that looking to them to give us quality assurance on the digital numbers, which would be helpful. I mean, I've dealt with FactSet, FactSet data is good, but any of us that have used it or Capital IQ
knows that if you don't fact-check the stuff, when you put out a research report, you're probably going to have an error to it. It'd be nice to avoid that, but I don't think I'd hire a Big Four to do that data check for me. And I think you got to seriously get back to what is the problem and who are the best people to solve that problem. And when I look at that, it's probably not a Big Four firm.
Chairman Doty?
Well, in order to prove that I've been listening, but at the risk of making clear I've misunderstood, I really see it's a very interesting thing that two quite different approaches to standard setters and regulators emerge here, I think. One is slide 16 of the presentation. Gary, Bob, Mike have all in one way or another spoken to or outlined a kind of a single leap approach. The regulator does such outreach and gathers such information as the regulator needs, and then they take a single leap. Not confusing KPIs and non-GAAP financial metrics, which I now understand from Wes and Mark and Marty are really quite different and require different approaches. Nevertheless, what you're suggesting is to start studying a single leap, or to think about what that involves. And it's a challenge for regulators. The other I would characterize as a kind of convening approach, isn't it? Kevin, Linda, Anne Mary, Lynn, and Lynn's granulated KPIs, you are, without endorsing SASB, you're nevertheless suggesting a kind of convening approach. The regulators call together industries and industry groups, and you say, okay, you tell us. You tell us what the KPIs or the non-GAAP financial measures are. We're then going to tell you what you can do with them and what you have to do about consistency and about presentation and disclosures. And you get here, I think, a kind of intergrade of private standard setting that we're familiar with and government oversight. They're very interesting approaches. The latter one resembles a little bit more FASB and financial standard setting. The former a little bit more the 33 Act disclosure regime. Neither of them seem to me obviously easy to implement. They're both have challenges, but I don't think what we've heard is any approach to the how that Steve is reaching for, how to get there, unless we come up with some combination of what seem to be conceptually two different approaches to standard setting for disclosure. I don't know. I find this fascinating.
Tony, before I turn to you to wrap up, Kevin, I saw you nodding when we brought up the subject of ESG and that more institutions are looking at ESG criteria, and you representing BlackRock or being here. Could you talk a little bit about what you look at in the ESG and where you see that moving?
Sure. So this is largely being driven by, well, let me take a step back. So one of the interesting things you find about ESG is in the eye of the beholder. That is, it defies a common set of definitions and circumstances. It is beginning to evolve, but one of the things we sort of alluded to in the conversation about SASB sort of moving down the path to try to help define some standards. But ESG, sort of the broad rubric, runs the gamut from, or this is how we think about it at BlackRock anyway, and looking at ESG-related factors just as part and parcel of our investment decision-making. That is, what do those factors indicate about how we think about the long-term value creation of a particular entity and the management, and so ESG factors are being incorporated into our investment processes across the board. And then as you sort of migrate down the path of what that means relative to our stewardship responsibilities, and then what that means in relation to very explicit investment decisioning, either affirmatively to include certain types of activities or industries, or what we historically had thought about the early evolution of ESG, and that is sort of screening certain types of activities. And so we actually think it's sort of a very holistic approach that doesn't sort of lend itself to any, but imbues the entirety of our responsibilities. It's being largely driven initially by clients because it's increasingly become more important from clients' perspectives. And we have Anna here in the room. I'm sure she will echo those, as well as Amy, from wearing their client hat. And we see not as much in the U.S., particularly not of late, but certainly on a global basis, it has also made its way into the regulatory fabric of various jurisdictions in either evaluating or measuring these kinds of criteria, and in some instances even sort of mandating certain. So we see that in sort of the governance framework, right, where there are initiatives to mandate or at least monitor the level of women, for example, on corporate boards. So this is, it is sort of earlier days in the U.S. context. It is increasingly more important to clients, and it's increasingly more important not only to institutional clients, but even to sort of individual clients as you begin to look at some of the surveys that have been done of the significance of this for some of those investors who've never seen a downturn before, but for
Right. Two-thirds of them.
But increasingly, these are criteria in which they are looking to evaluate investment decisions. And for those of us who act as fiduciaries for those clients, increasingly in how they evaluate how well their fiduciaries are acting on behalf of their interest.
Thank you. Tony, well, first of all, thank you. I'll let you wrap up. Oh, I'm sorry, Wes, please. Wes Bricker.
I'll certainly let Tony have the last word on an important topic. Maybe just a few observations from my perspective. One, the value and the diversity of the dialogue, I think, has been helpful. It certainly reflects the diversity of investor approach to evaluating performance. It also reflects the diversity of management approaches. That diversity, I think, is reflective of a quality of our capital markets, that there isn't necessarily a singularity of investor approach or a singularity of management approach. We wouldn't want that. Nonetheless, we do have accounting standards which have at their heart comparability among other objectives. The measure produced in that context is net income, resulting in earnings per share for public companies. And so I wanted to use the opportunity of a rich discussion to make a point which I appreciate is slightly beside the point of this discussion, that the prominence of GAAP comparable reporting comes ahead of non-GAAP reporting. So I emphasize it's the placement of non-GAAP reporting and the placement of KPIs is important to our overall approach here. Secondly, the FASB, of course, has wrapped up a multi-year consultation and survey-taking process about the important areas for its agenda going forward. I would certainly commend the investor user community to the outreach that they've done and what they've published on the basis of that outreach. Third, for audit committees, I do think audit committees play an important role in this area, focusing on things that they can do immediately, like asking management for more information about the policies that management has for non-GAAP reporting, inquiring about the nature of process and control that is embedded in company reporting today, and asking for outside perspectives regarding that, whether it's the auditor's outside perspective, other advisors, or other perspectives. There's an opportunity for audit committees to continue to focus in this area, particularly for companies where there are concerns about quality. So separating quality from standards and standard setting in the discussion, I think, is important. But thank you.
Thank you, Wes. Tony, thank you, and thank Amy and Bob, and the last word is yours.
Is that singular?
Is that it?
Thank you, Steve. I'm struck by a couple of things. I was thinking about what Lynn has been saying, and I really don't think there's a very big difference between what he and I are talking about. If you go back and take a look at my book on financial analysis, the first line says that in order to be an investor and an analyst, you have to be cynical. So I think with respect to management definitions, I hope I'm going to follow that first line. But I don't know that it can be done otherwise. I'm not convinced that the FASB can do it. I do accept and I agree. Several years ago, the business reporting model was a very good exercise. But I don't think that in the last few years, the boards have shown that ability again. I think, for example, we're finally at a point where we understand and therefore now have a standard that says an operating lease, the right to use an asset, the right to access it, et cetera, is the same as buying it. We're finally acknowledging the economic equivalency. And 2 weeks ago, I was encouraged because at the Emerging Issues Task Force, we finally acknowledged the economic equivalency of selling a license to cloud computing, the subscription agreement. And we're finally on a move where I think we're going to make a difference. I do believe that the cash flow statement is a very critical issue. The direct method is important. I'll confess, I served on the committee that helped the IASB write IAS 7. And I still remember the 2.5 hours that I spent trying to convince David Cairns, who was then the chairman of the IASC, to adopt the direct method. But it didn't work. So I hope one day we'll have that. My final point is that I do believe that we're going to need, and Chairman Doty, I think I come back to your point about those two issues you're saying and how do we bridge that gap. And I think the way to do it is to have standard setters and regulators provide us with a framework, but let the managers define, but stay consistent with it. And that, I think, is going to be the way to do it. Thank you.
Well, with that, let's take the lunch break and be back at 1 o'clock. Thank you.